Financial Planner, presented by BSC, Investors Protection Firm.
Hello and welcome. You're watching Financial Planner. Over the next 30 minutes, we'll talk about a very interesting subject to most of our viewers, and that is, of course, wrong investment strategies that could actually spell disaster. To talk about that with us, we've got with us Hemant Rustagi, CEO of Wiseinvest Advisors. Thanks, Hemant, for coming by today. Hemant, to begin with, anybody who's put money in between 2007 to now, which is about 5 years, has only burnt their fingers, be it through direct participation in the equity markets or be it through mutual funds. That, of course, has impacted the sentiment to a very large extent, right? Tell us about what has gone wrong over the last 5 years, because I think 5 years would be termed as a long-term investment. If you're still not being able to make money, or if lazy money is still not creating wealth, what does one do?
Well, I agree with you, Samina. In fact, it used to be 3 years. Now it has become 5 years, thanks to what we've seen in the market. I think there are a lot of factors that we've seen why the markets have behaved the way they have behaved. I agree with you that someone who made one-time investment, say even October 2007, would be maybe in losses, unless he has really invested in good funds, which has been able to, beat the market and give you better return. But even there, the returns are going to be very marginal. The key here is when you invest in equity, you can't make it a one-time affair. So if you were investing in 2007 or beginning of 2008 because the markets were going up, unfortunately, that's a time when investors get attracted to equity market. So when you're investing in a rising market, okay, and then when the moment the markets start falling, maybe you stop all your investments. On the opposite side, if you really see investors who've been investing systematically through SIP or regularly as and when they had investable surplus, they have made money. In fact, if you see in these 5 years, we touched almost 20,800, 900, came down to 8,000, went again in October 2010 to 21,000, and again we are down to around 16,000 odd. So I think there's been increased amount of volatility in the market. Investors who have been investing regularly have made money. Unless if you invested like one time and your timing was right. Otherwise, if you invested in 2007 and 8 and after that you not followed it up, you haven't made money.
Hemant, apart from the fact that macro concerns, there are huge headwinds, and we're not only talking about India's problems, but globally the situation is looking very uncertain, which could, of course, shake anybody up. What I want to understand from you, apart from those worries, there's an enormous amount of mis-selling, lack of understanding. People are still not educated about what needs to be done, what one should be doing. I think most people who make investments, it's for tax saving. I mean, we get a lot of queries. Very rarely do you have people talking about wealth. Yes, it's gotten better in the last couple of years, I would say. But your first prognosis of any situation is, I want to save tax, so what should I invest in? So do you also think there's a lot of lack of understanding, mis-selling that's taking place that has dented sentiment?
I think the fact that equity has failed to find a permanent place in the investment universe of investors is, I think there are a lot of reasons. Some of it you mentioned about mis-selling. It's also about, how equity is perceived. If equity is perceived as an investment option where you can make a quick buck, obviously you're going to get into trouble. The fact remains that equity as an asset class has the potential to perform better than most asset classes over a period of time, provided you are committed to invest for a long term, and at the same time you are a disciplined investor. Now, discipline does not necessarily mean every time you invest money it has to be through SIP. It's a commitment that as and when I have long-term investable surplus, I will invest that in equity. So if you come with a clear game plan, clear allocation, I think then the disappointment won't be there. The problem is, when you get into equity, because most investors, if you really see, unfortunately maybe the number is going down now, the thing is that they get attracted to equity investment when the markets are doing well. And then what happens? They come almost at the fag end of the rally. Okay, and then they get into some very aggressive funds. And the moment the markets start falling, they stop all their investment. That is why this happens. Yes, it is true that what we are witnessing in the stock market is an increased amount of volatility compared to what it used to be like 3 or 4 or 5 years ago. But the fact remains that it's a natural phenomenon in the equity market. Anyone who invests in equity has to be prepared to face volatility. And you are well prepared when you come into equity with a defined time horizon and a clear objective.
And you've got to be patient, because that, of course, is evidently crucial, not get wound up by the volatility or uncertainty globally.
Yes, like I said, if you come with a defined time horizon, you're mentally prepared to wait that long. So if you just get in because you want to make a quick buck, you're not mentally prepared to suffer losses. And that is where, you take some, decisions which go against you in the law. So one of the criteria, of course, is past performance, but you have to look at long-term past performance of maybe 5 years or so. The reason is that in that 5 year, it would have actually that fund would have actually seen at least 2 cycles in the stock market. That tells you how consistent the fund has been. And even there, I would say, don't look at only simple annualized return. Also look at what we call as a rolling return, which breaks into basically each year. And you see how consistent the fund has been. Now, because what happens is, suppose that the 5 years, the fund has not performed for 3 years, and 2 years it has done very well. The 2-year performance will improve your annualized return, average return. But you need to also look at rolling return. That tells you how consistent the fund has been. But that, as I said, is only one criteria. The other criteria are what kind of asset allocation you want to do. For example, if your asset allocation says 40% of money or 50% of the money has to go to equity, invest only that much. If you invest in every fund that comes your way, the chances are you may end up investing 50, 60, 70 or 80% of your money in equity. That's where you get into trouble. So look at what is suitable for you. Look at the fund's consistency, both in terms of performance as well as in terms of following his own investment philosophy and strategy. Because the offer document of every scheme clearly spells out what kind of stocks they're going to have in the portfolio, whether it's going to be a multi-cap, whether it's going to be large cap, whether it's going to be purely a mid-cap kind of fund.
Goal is what you
yes, absolutely. Look at where it's going to invest. Make sure that is in line with your investment goals. Okay. Look at past performance. Look at consistency, both in terms of
and
performance.
Relative performance as well. Because I mean, if you've got a fund that's doing well, but its peers are doing better, then obviously we've got.
Yes, you know, every fund has a benchmark. That's a very interesting point actually brought. Is every fund has a benchmark. Now, one way is to see how the fund has done vis-a-vis the benchmark, but that doesn't tell you the whole story. You also need to compare that with the peer group. For example, if you're invested in a pure large cap fund, and let's say the benchmark is BSE 100, there are other funds in the same category. This fund might have done better than BSE 100,
but
if it has underperformed the peer group, right? So then obviously your fund is not doing
well. So you've got to take all those factors in mind.
Absolutely.
Well, Hemant, also I think a lot of people that we talk to land up, I know diversification is crucial, and diversification across asset class is something that we stress upon a lot to make sure, you know, your fund is creating or your investments are creating wealth. But over diversification across a number of mutual funds could be a problem, right? I mean, I know a lot of people who've got like 15, 16, even 20 mutual funds. They invest about 1,000 rupees each and every month. Now, this doesn't really work out because, first of all, managing such a large portfolio is difficult to begin with. And of course, if we have very little experience, you know, the job just gets tough at hand.
Also, I mean, it's a very common problem. You talked about 20, 30 funds. Believe me, I've seen portfolio where there are more than 100 funds.
Oh my God. Okay.
And that, you know, why it happens is because...
You want a piece of the pie.
Absolutely. You know, first thing is you invest in every fund that comes your way. Somebody comes and says, this is a good fund, it's going to give you a good return.
You go and invest.
You're not following asset allocation. You haven't decided how much of your money should go into equity and how much should go into debt and how much should go into gold. You are simply going by return. As we just mentioned, past performance can be misleading, you know, when you're looking at short-term or medium-term. So when you keep investing in every fund that comes your way, at the end of the day, you suddenly realize you have 30, 40, 50 funds, which is clearly a case of over-diversification. What investors need to understand is that every fund has a specific goal or objective to achieve. Now, when you're investing in a fund without understanding what this fund is going to do, you may actually end up having 10, 15 funds behaving exactly the same way. Now, what will happen in your portfolio in that case? They will all go up when the markets are going up. They'll all go down when the markets are going down, exactly in the same proportion. So what is required to be done by the investors is look at a few select funds, okay? Look at basically what exactly they want to achieve or where they're going to invest. Like I said, there are multi-cap funds, there are large-cap funds, there are mid-cap funds. Look at that, where exactly they're going to invest. So you select how much money you want to invest in large cap, mid cap and small cap. Depending on that, you decide on a few funds which have been doing consistently well, like we just discussed about that. Another also thing to understand is the mutual fund investor benefits from diversification in many other ways. How? One is that you invest 5,000 rupees in an equity fund. You actually own a part of the portfolio which has more than 50, 60 stocks.
Right.
Now, this is a great diversification tool, actually. So your money gets, you know, diversified across sectors, across stocks. Another diversification comes in the manner that, like you, there are thousands or lakhs of investors investing in that particular fund. So when the markets are going through, a volatile cycle, you may not be investing, but there are others who are investing in the fund. So it kind of brings the average cost of the stocks in the portfolio down. You as an investor benefit. So one, have very few funds.
I just want to comment on that one because a lot of people, I think the common mistake is that if you've got a larger pool of money to invest, you invest in more funds.
Yeah.
And if you've got lesser money to invest, then you stick to lesser funds. Is that even true? Even if you're investing a large sum of money, you could be comfortable with 5 funds if that.
Oh, yes, absolutely.
So you increase the quantum of investments in the funds as opposed to going horizontal and investing in more funds.
Oh, yes, absolutely right. It's not about the size of the portfolio.
Money, right?
Maybe, yes, it'll make a difference of having maybe a couple of more funds or something like that. A
But
portfolio of 10 lakh, they can have 3 or 4 or 5. A portfolio of a crore can have maybe, another 2 or 3 funds. That's about it. Because let's not forget one thing. Whatever money you invest gets spread across 50, 60 stocks, as I mentioned.
Yeah.
So imagine each fund having 50, 60 stocks. And there will be some common stock, obviously. Some common stock. I mean, how many stocks you want to have in the portfolio?
Right.
Imagine your portfolio is invested in more than 100 or 150 stocks. I think clearly a case of over-diversification. So one should, like I said, irrespective of the amount, there can be a variation of 2 or 3 funds. That's about it. Right. Maybe, when you have a larger portfolio, some money can go into, aggressive fund like sector fund or thematic fund.
Right.
That's why you can have those additional number of funds.
Right.
Otherwise, I think every single fund which is properly diversified gives you fantastic exposure across sectors and across segments.
Another common mistake a lot of people make is trying to enter into a fund just before the dividend payout is there. I know this sounds, the face of it is a quick buck, but there's never a free lunch. I'm sure there is a hidden picture that most people don't understand and therefore get carried away with getting into a fund just before the dividend.
Well, you're absolutely right. This is a common myth which I think somehow investors have been following for years together. The reason why it looks like a great proposition to them is, one is because the equity fund give you a dividend of sometimes 20% or 30%. They don't understand, the investor need to also realize that it's on face value. It's not on the dividend. So for example, a fund which has an NAV of 40 rupees declares a dividend of 100%, it's on 10 rupees. So the dividend is 10 rupees. The second attraction for them is the tax-free status of the dividend that you get from equity fund. So the common belief is that if I invest just before the dividend declared, within 3-4 days I will get a part of the dividend without realizing.
Only if it was that easy.
Absolutely. Without realizing that what's happening. Let's understand by way of an example here.
Yeah.
Let's look at a fund which has an NAV of 40 rupees just before the dividend. An investor invests 10,000 rupees in that. He gets allotted 250 units. This fund announces a dividend of 100%, which I said is on the face value, not on the NAV. So he gets a dividend of 10 rupees. He gets 2,500 rupees back, maybe in the next week or so when the dividend is declared. But he forgets one thing, that the NAV will come down by 10 rupees.
As soon as.
So the 40 rupees will become 30 rupees. His investment value post-dividend will come down to 7,500. So what happened?
He's lost 500 rupees.
So what happened? No, he didn't lose anything. He got 2,500 rupees as dividend. 7,500 is his value. Is back to 10,000. So how did he gain anything? In fact, he's going to be a loser. I tell you why. Why do you invest in equity? You want this money to keep invested for 2 or 3 years or 5 years. Now, suppose in a market situation like this, which I believe is a good time to actually enter, a fund gives a dividend and you take out your 2,500, this is the time to put money. So in the long run, while your intention was to invest 10,000, only 7,500 was invested in the fund. 2,500 came back, and what you're going to do with that money? You will end up spending that money. So the money which would have helped you in accumulating some amount of corpus.
You managed to actually pull it down.
Absolutely. So I think it's not a great idea.
Very quickly, Hemant, focus is usually on equity as opposed to debt. A lot of people don't understand debt. That could also be the other reason. How important is debt to be a part of someone's long-term portfolio?
It is absolutely important. You're absolutely right. Because equity market is so much in limelight that everyone focuses on equity funds.
If you had channels doing debt portfolio, would probably.
Oh yes, absolutely. And the debt market, as you rightly said, is also very, very complicated. Much more complicated for a common man to understand. And the reason for that is very simple. Because there is an inverse relationship between interest rate and the bond prices. Okay, they behave differently. For example, what happens when the interest rates are going down, the bond prices will go up. When the interest rates are going up, the bond prices will go down. So what happens then is that your funds, for example, in a high interest rate scenario, you have fixed maturity plan which give you fantastic return. In a rising interest rate scenario, you have ultra short-term liquid fund, short-term fund giving you good return. When the interest rates start going down, FMP's return will come down. Okay, the income fund will start doing very well. So, at different phase of interest rate cycle, there are different kind of funds that do well. So it's very, very important that, imagine a situation where you invested in an income fund and you made good money when the interest rates were going down. When the cycle reverses, you're still in income fund. So whatever gains, if you don't do that, if you continue with that, whatever you earned actually during the bull run, you will actually kind of squares up, or you might even lose a part of it. So it's very, very important to keep an eye on debt funds also.
Well, that's of course a lot about mutual funds and investing, right? We'll take a break. We'll come back and take up your financial planning queries.
The Financial Planner, presented by BSC, Investors Protection. The Financial Planner, presented by BSC, Investors Protection Firm.
Welcome back. You're watching Financial Plan. It's now time to take up all your financial planning queries.
Investment Ladder, presented by BSC, Investors Protection Fund.
Hemant, we've got a query coming in from Dr. Sandeep. He's 32 years of age. He's got 2 dependables. He's got expenses of 25,000. He hasn't told us what his salary is, so that's a bit of a problem. He's got his insurance in place. He's got some of those funds that he's invested in, which I think you've already had a look at. And he's got a liability in terms of a car loan EMI. His goals are pretty common. He's got his son's education where he needs 2 crores from, retirement requirement of approximately 1.5 lakh per month, and he's got a house 10 years from now that he's looking to buy, which is 75 lakhs, but that's an optional goal. What do you advise Sandeep to do?
Well, I think from the detail that Dr. Sandeep has given, it's quite evident, as you rightly said. In terms of risk cover, I think he's done fairly well. Right. He has a term plan of 75 lakhs, and I think he wants to add another one of 75 lakh. Even though he's not given his annual income, if I look at his expense and all, 25,000, I believe that I think he's done all right. And for health insurance, he has a family floater plan for 5 lakh. Being a young family, maybe as of today, it's all right. But I think after some time, you need to really think of enhancing that. The first problem that I see in the portfolio is in terms of emergency fund. He has created an emergency fund of 25,000, which is equivalent to his 1 month expense. Generally speaking, I think it should be at least 6 months. So he needs to add another 1,25,000 to make sure that he doesn't have a problem in case he has to face an emergency. And the advantage of having a proper emergency fund is that you can then continue your long-term investment uninterruptedly. You don't have to really stop that process because, when there is an emergency, you need that money. So as far as risk cover is concerned, I think he's done well. He has 3 goals, basically. The first goal is for son's education. He has a time horizon of 16 years and looking to build a corpus of 2 crore. So if I'm assuming a return from a portfolio of, let's say, around 12%, he needs to invest around 37,000 rupees per month to achieve that. His second goal is after 25 years, he wants to retire after 25 years, and he wants at that point of time a monthly income of 1,50,000 rupees, which means that he will require 18 lakh rupees annually. Now I'm assuming that he's able to earn, let's say, 6% tax-free at that time. So he will need a corpus of around 3 crore to generate this kind of money. Also, let's not forget that there's also going to be inflation that will come into play, because maybe he will begin with 1,50,000. After some years, obviously, his monthly expenses will go. So he needs to have that flexibility. He will need to create a corpus of around 3 crores there. To do that, again, assuming a return of 12%, he needs to invest around 18,000 rupees, 18,000 per month. Okay, then the third, which as he said is optional one, is to actually create a corpus of 75 lakhs after 10 years to buy a house. For that, he needs to invest 34,000 rupees per month.
Really overstretching himself.
So I think in all, he needs to invest 89,000 rupees. I don't think it's possible for him that. Because he said the third target is optional, maybe he can forget that right now, focus on his 2 more important goals, and then he needs to find ways of how he can invest that additional money. If he can't do that, clearly there is a need for him to revise his target. Okay. Now, as far as his existing investments are concerned, I think he has a mix of equity-oriented balance fund, equity funds, and PPF and EPF. I think as a combination, and even the fund selection has been quite good. But if he continues with the present size of investment of 12,000 in equity, then I think 6 fund there is definitely scope to consolidate. But if he decides to increase that amount in equity based on what we have told him that how much he needs to invest, then maybe he can carry on. So as far as existing investments are concerned, he need not really make any change. But clearly there is a need that he needs to add more investment to achieve the goals that he has in mind.
Right, Dr. Sandeep, you might need to go out there and rationalize your goals a little bit because, of course, 90,000 rupees is what you're talking about if you do want that optional house as well that you've mentioned to us in your goals. Like Hemant said, fund selection is okay, but you might need to consolidate and bring down the number of funds that you're investing in right now. We'll take a break on that note, but we'll come back and continue taking your financial planning queries.
The Financial Planner, presented by BSC, Investors Protection Fund. The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner. We have a query, Hemant, coming from Dipin Joshi. He says he's actually still studying. He's doing his master's and will be getting a job by mid-2013. He wants some help in deciding his investment plans. He'll be earning about 60,000 per month and can save about half of that, which is 30,000 rupees. He's only 25 years of age and he wishes to make investments that generate a high return. What do you think he should be doing? Safe and risky investments as well?
Well, it's really nice to see someone who's still studying and, already planning his investment when he starts working next year, which is something great. I think that is what I think needs to be done. But I think the right way for Dipin would be that as and when he starts investing, as I said earlier in the show, he needs to establish his goal. All of us want to make money from investment, that's all right. But there has to be clearly an investment plan in place. There has to be clearly that what goals you want to achieve from your investment. So my recommendation would be as and when you start investing the money to establish his goals, short-term, medium-term, long-term, because that helps you in terms of deciding what kind of asset allocation you need to have. So first step has to be decide asset allocation. Then once you decide how much money should go into equity, gold and debt, then you look at fund selection. I think we can recommend some funds to him, but we're talking about investing 1 year from now.
Yes,
maybe it's not really relevant at this stage, but some of the funds I've already mentioned that he can be considered here. But like I said, if he is going to establish his goal and then follow that process, he'll make sure that he doesn't take more risk than what his risk-taking capacity is. So I think if you follow that process at that point of time, it's going to be really good for him.
So basically outline your goals first and then work backward and determine how much you want to invest and how much. What do you think about the amount of money he's saving? About 50% of his monthly income. That's actually quite good, right?
Well, I think
and he's not asked us about insurance. I'm a little concerned about what...
Well, he's young. He actually studying right now.
So he doesn't have any
dependents. So I don't think you need to really worry about insurance.
So when he starts making this investment in mid-2013, do you recommend him to take up insurance?
He can because, if you take insurance at a younger age, obviously your premium is going to be that much lesser. But obviously the concept of insurance or risk cover comes into play when you have dependent. Okay, it's only when maybe he gets married, he'll have somebody dependent on him, then he can start looking at it. As you mentioned, about 50% of his salary, yes, he's at the beginning of his career, and if he has no other liability, he can definitely go ahead and invest 50%. Definitely that will be really good.
Investment Ladder, presented by BSC, Investors Protection Fund.
Right, Dipin, you're on the right track, like Hemant said. Starting early, that's always good to create long-term wealth. That's also all the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.